Matt here from Hashtag Analytics again. I've wanted to do a video on one of the suburbs that we've been getting a lot of requests for through our socials as well as through our contact email at Hashtag. I just wanted to delve a bit deeper into the actual suburb and look at, I guess, how the metrics are performing and how the suburb is positioned with respect to capital growth and cash flow. The suburb in question is Baulkham Hills. This suburb has also been searched a lot in Google for some reason. Well, when I started delving deeper into the figures, I've actually realized why. But I guess without further ado, what I'll do is first, as usual, guys, you have to log on to our website. And the suburbs is in the Hills Shire Council. If you start searching from the first page of our website and you have the council toggle clicked on, you can put in Hills Shire, then you click onto the Hills Shire and you're provided with the LGA page and all of the suburbs will be presented there. You can actually access it much quicker is you can just toggle onto the suburb view and just type in Baulkham Hills and you will be provided with the suburb. The suburb, I believe, is in northwest Sydney. Let's look at its geographic location. Yeah, so it's northwest Sydney. It's next to Kellyville, Dural, Quakers Hill. That's pretty much everything that's around. Seven Hills, Parramatta. From memory, I remember about 15 years ago when I was looking into, I think about 20 years ago, actually, when I began my property investments research journey, I was looking into Sydney Southwest and Sydney Northwest because they were branded as growth corridors on council websites. Government has been putting in a lot of money into these two areas, and I guess Baulkham Hills falls into the northwest growth corridor. There's a lot of infrastructure investments been happening in that area, and we can definitely say that by looking at the market snapshot, if you can see the disparity between typical price expressed in thousands and rent, it's more than double. So when I look at this disparity, I guess my affordability radar starts working. Usually when there's a big gap between the typical value expressed in thousands and rents double or more, that means that the area has seen a lot of capital growth and not a lot of rental growth, which means that potentially the area is overvalued and is not affordable anymore. We can definitely see that from the yield itself. The yield is 1.86%, which has seen a bit of a growth, 11% in the last year. However, the yield is so minuscule that I guess if you guys investing in this suburb, it will require a lot of additional cash to maintain the property, simply because the rents are too low to cover everything. We can also see that from the RCS score. I'm not surprised. Let me just see, guys, going back. I want to have a look at actually the growth within Baulkham Hills in the last decade. So usually how you do that is you would toggle back onto the LGA view, you would hit the expert view of the column, and then everything is expanded. As you can see, the actual typical price columns are expanded substantially. And this is where you can locate how the price has been performing in the last year, 3 years, 5 years, and 10 years, as well as in the last quarter and month. So looking at Baulkham Hills, let's delineate it so it's easily discernible. Yeah. Okay, so we can see that there's been 140% of growth in the last decade, which means that within one property cycle, the area has more than doubled in value. That's definitely also obvious from such a disparity between, let me just go back, sorry guys. Yes, such a disparity between the typical value and rent expressed in thousands. It has seen 40% in the past 5 years. Looking at yield, for example, guys, look at this. It's seen only 21% increase in yield in the last decade, which is virtually nothing in comparison to other areas. So definitely this area has seen a lot of growth in the past, although that doesn't usually highlight that there's going to be substantial growth in the future. What that tells me, for example, is that there are solid market fundamentals and that the area has seen an imbalance between a supply and demand, I guess favoring the demand in the last decade. And one property cycle is a substantial amount of time to discern whether there are right fundamentals for the area. That's why its RCS score is substantially low, which I think it says it's 88. That's really low. The cash flow, however, is 27. When I say really low, I mean there's a low risk to invest in the area, but the score itself is fairly high. And when it comes to the cash flow score, it's fairly low, 27. which again, look at the yield, guys, 1.86%. The capital growth score is 98. So when it comes to the RCS scores, what I like to point out is they also provide a percentile brackets. So when we say that the cash flow RCS score is 27, that means that the area is within the bottom 27% when it comes to the cash flow in Australia. So there are definitely better opportunities out there when it comes to cash flow. However, are they accompanied with substantial capital growth? Usually when one domain grows, the other doesn't. It is very hard to find areas that both grow substantially. It is very hard to find areas in Australia where you can see above 80 scores for cash flow and above 80 scores for capital growth. That would be a hidden gem. And using our platform, you can actually short circuit the search and do it in seconds to see whether that's possible. I'll probably do a different video on that. But for now, what I'd like to say is that although the area is within the bottom 27% when it comes to the cash flow, it's in the top 2% when it comes to capital growth. So that's fantastic. Its overall score is a little bit on the lower side. It's not over 75, which I would consider as an opportunistic metric or highly opportunistic. It's 71, simply because it's been dragged down by the cash flow RCS, because the overall score is the average of all of the scores. However, if I was an investor who has money, who has a large deposit to put down, and I do understand all of the tax benefits that I can take advantage of, and I'm a long-term investor, that's one thing that I like to point out. This area would actually fall within my radar because it has a very high capital growth score and a very high low risk score, which means it's less risky to invest in the area. However, let's delve deeper and see what other metrics are showing and highlighting for this area. I will expand the information to capture all. So we're going back to 2007. We can see that the trend line is somewhat sporadic, which I usually take as a bit of a concern. However, if we exclude this last end of growth from 2021, why am I excluding this last spurt of growth? Well, simply because during the pandemic and a bit before that, the governments have been printing a lot of money, and money has been easily accessible. And I've mentioned this continuously in my other videos. So a lot of areas have seen this exorbitant growth, which sort of falls outside of the trend line. Okay, and remember when I looked back at the error rate for our forecast. So if you go back to the forecast that we put forward for Baulkham Hills, we can see that what we're anticipating is between -7 and +19% growth, and the error rate is 12.9. So the error rate is fairly high, meaning that, and this is usually what I tend to see is that a lot of people consider high error rates as a problem. So first, what is an error rate? An error rate is the difference between the actual and the forecasted typical price, which we backtest yearly. Okay, and a lot of people, when they see a big error rate, in this instance it's 12.9%, they think, oh yeah, your forecast is not actually working. That's a problem. I'm not going to look at your forecast. This is not the case. Please do not consider it in that way. If the error rate is high, that means that the price has deviated from the trend line. Okay. So in some instances, that's very positive. If the error rate is high, and in instance in Baulkham Hills, that's definitely the case. The price has dramatically deviated from the trend line, as we can see, and has grown substantially. This is the hierarchy. When the market has the right fundamentals, when the market has solid RCS scores, okay, and how do we discern fundamentals? Well, we look at the growth in the past decade. When the market has solid RCS scores and then it has a higher error rate, that means that it's been deviating from the trend line and is potentially positioned for further substantial growth. Going back, what I'm trying to say is that this deviation from the trend line is definitely exhibited in the higher error rate that we've seen. So going back also to the forecast, again, what I like to emphasize is that, yes, we are forecasting a cone of growth between 7 and 19%, and this is the cone, guys. But because its error rate is 12.9% and its RCS score is 98% and its fundamentals are right, I can predict that the growth in Baulkham Hills is going to be closer to the 19% than 7%. Okay, I'm certain of that. So that's how you should read our forecast. Going back to everything else, we can see that the rents haven't been increasing that much, which is why the yield has been substantially plummeting. looking at its RCS, it's actually interesting, and specifically it's interesting within this area here between 2016 and 2018. Why? Because it was a little bit out of sync, and this was before the pandemic, so I'm not sure why this has happened. And I guess this is the area what we're talking about where it's been seen a substantial, I guess, decrease in price, and probably because the area itself was a little bit overvalued. So I guess the demand was spilling over into adjoining areas, which has seen a plummeting of prices in Baulkham Hills, and that's exactly it in 2017, and we can see that from the RCS. It's a bit sporadic here, but if I exclude this section of the graph, we can see cyclicality in price change. Again, RCS and Delta 10, which is the growth in the past decade, are two indicators they usually use to ascertain market fundamentals. If RCS is cyclical in nature, that means the market fundamentals are correct, and usually because of macroeconomic conditions such as, I guess, interest rates and the supply of money, prices inadvertently change in a cyclical way or move in a cyclical manner. That's healthy. So overall, I guess it's RCS exhibit cyclicality. The cycles move from 2, 3 to 4 to 5 years. So it's not an analog of 2 years or an analog of 4 or 5 years, which is actually even better because if we wanted to time the market, we can anticipate it a bit better. And this is why the forecast is provided here. If you're looking to buy and flip, for example, you can time the market by, let's say, buying a property at the bottom and then leveraging its momentum thereafter for growth. I think I've done a video on the buy and flip strategy, which you can find on our educational side of our website. But coming back to this, one concern that I do have is that market has seen a rather substantial negative growth of -7% in 2018, which was preceded by the decline in 2017. And again, I believe that this is because the area was overvalued. But then we have again seen access to cheap money beginning on the pandemic, and here we go, boof, a steep rise in values. Going back above, IRSAD. I usually pronounce this wrongly. I say ISRAD, but it's not ISRAD. But anyway, let's say it's ISRAD for now. ISRAD score is 10, which is perfect. So that means that socioeconomic standards of the area are pretty high. There's money in the area is affluent. That's always a good foundation when it comes to considering whether you want to invest. One interesting fact here is, and I've done a write-up, I do an analysis and I do a write-up of the area, and I put it into the comment section below to provide feedback, to comment on particular statistics and what they believe is the case and how they see the area will move. Please read what I've written. Look forward to hearing your thoughts. Comment at the bottom of the suburb page. There's a lot of renters in the area, but the ISRAD is not low. And then it dawned on me that it is much cheaper to actually rent within the area than to buy a property. Look at the disparity between the typical values and rent. Baulkham Hills is actually a very nice area, and I really like the area. So if I wanted to live in the area, I'd much rather prefer to rent it than to actually buy because I can't afford to buy. I've been priced out of the market. Its typical value is $1.6 million. So this is why it dawned on me why there's a lot of renters in the area, not enough owners. And see, this is a perfect segue to demonstrate that you should not look at one metric. If I looked at this metric alone, I would say, okay, this is a huge concern. I should look away from Baulkham Hills. But then when you combine this metric here in unison with the growth in the last decade as well as its ISRAD, above here, you can see that this is a very affluent area. There's a lot of money in the area. There's been a lot of growth in the area, hence why people prefer to rent at the moment because they've been priced out of the market. They want to live there. It's a livable area, but they can't afford to buy. Moving further down, a proportion of units to houses is balanced or I guess positive. No concern here. Going further down, let's look at the supply and demand metrics. And this is where you realize how much of a powerhouse Baulkham Hills actually is. First, look at the snapshot at the top. So we've usually color code our metrics because we just want to provide information quickly to our customers. Green means opportune, orange or yellow, depending. I'm a bit colorblind, so sometimes I see both depending on the mood. So orange or yellow is balanced and red is unfavorable conditions. Look at all of the supply metrics. They're all opportunistic. And all of the demand metrics are opportunistic. What does that mean? That means there's a reduction in supply of properties and an increase in demand. That's a perfect storm. And this is why, again, coming back to the projection, this is why I think we're more inclined to see a 19% increase in the next couple of years or this is annual forecast, then we are to see the 7% increase because the supply and demand metrics are perfectly imbalanced. Look at the trend line as well, guys. I always say look at the trend line. The trend line is very important. When you look at the numbers on a page, and a single number cannot really tell you much. So a single number does not tell you anything. 3, 4, 5 single numbers, which equates to 3, 4, 5 metrics on a page, tells you a bit of a story. And then what paints a perfect picture is when you introduce a trend line, when you introduce a timeline to those metrics, and you can look back to see how the suburb has been behaving historically. And then you're much better equipped to actually project or anticipate what's going to happen in the future. So look at the trend line, guys. So stock on market percentage has been substantially decreasing, trend line, since 2020. Okay, look at the inventory, guys, as well, plummeting. And pretty much the same angle for the trend line, stock on market percentage and inventory. On the other hand, look at the hold periods. The hold periods have been substantially increasing. And guys, I can see a sharp increase in some areas. When I do an analysis, I think I've done an analysis a couple of days ago of an area, and now it slipped my mind the name of the area. I was doing it for a friend of mine. And in the same way as this one, it was a sharp increase, but the hold period is 6.5 years. In this instance, the hold periods are 13.8 years, which again supports the livability factor of the area. People hold on average 13.8 years within this area. That must be in the top 5% of Australia. Not a lot of stock is coming onto the market. The inventory is being absorbed and the hold period is increasing. So you won't see a lot of properties for sale. Let's look at the demand. So days on market, again, opportunistic. It has been dropping. And not only that, the trend line has been dropping. Not as dramatically as stock on market percentage, but it has been dropping nonetheless. Look at the vacancy rates, guys. They have been plummeting. Okay, demand for rental properties, and again, this coincides with what I've mentioned previously. I rather rent within the area because the rents are so cheap, which is why there's a lot of renters in comparison to owners. And this is reflected in the vacancy rates dropping dramatically and plummeting. Look at the trend line as well. One other metric that I like to talk about is clearance rates. I usually don't talk about clearance rates when the macroeconomic conditions are as they are at the moment. When the interest rates are rising, not a lot of people buy property through clearance rates. And you can see that from other areas when you log onto our platform. The statistics is not there at the moment because auctions are just not happening. However, look at for Baulkham Hills. Not only are they happening, but they are edging 82% clearance rates. So the demand is exorbitant in the area. So overall, guys, I would particularly be, as an investor, scared of an area that has a huge disparity between typical value expressed in thousands and rent. I would say that the area has experienced substantial growth and is positioned to cool off a little. And you know what? It might so be that Baulkham Hills will cool off a little, which you can see from the growth rate forecast here. But judging by all of the other metrics, there's a perfect storm, and I think Baulkham Hills will see growth rates within the 19% mark or up to the 19% mark within the next couple of years or after the next couple of years. So for those investors who have money to spend and can afford homes in Baulkham Hills, I personally think that this area should really be considered by investors. Guys, thank you very much. This will be the end of the video. What I'd like to say is that please keep on sending us requests with regards to the areas that you would like me to analyze. You can either use our socials, LinkedIn and Facebook. We're mostly active there. But you can also send us an email or leave comments on our websites as well. I do highly encourage you guys to leave comments at the end of Suburb and LGA pages, either with your observations with regards to the metrics and where the market is moving, or just posting comments themselves. I will make sure that I get to them either in a written format or in a video format. Until next video, guys, take care, stay strong.